The no-fly zone, to be very clear about what that involves, is that means that if Russian planes violate the zone that's declared, we shoot them down. And that runs the considerable risk of creating a direct conflict between our countries and Russia, and thus a wider war, which is in no one's interest, including in the interest of the Ukrainian people.
That is not something, a position that this American administration supports right now. The Ukrainians are asking for it. The Russians are saying, don't you dare. And America is saying, we're not interested. Secretary Blinken also over the weekend making several headlines. An active conversation about banning the import of Russian energy into the United States of America. Well, the European allies joined. The Germans this morning pretty clear. No, no, no. Julian Lee joins us now for more. Julian, this is such an interesting market at the moment with really wide range of outcomes, a really wide range of outcomes. On the one side, you ban Russian crude. On the other side, seemingly you don't. Julian, what on earth do you do in the oil patch right now?
I think it's an extremely difficult situation. I mean, clearly it's much, much easier for the US to ban imports of Russian crude than it is for several European countries who are much more heavily dependent on it and have much less in the way of alternatives. So, you know, maybe what we're looking at is much more of perhaps a piecemeal approach, perhaps a degree of self-sanctioning that we're already seeing with some countries banning Russian ships, perhaps banning Russian cargoes in time, import bans in those countries where it is feasible to do it. You know, yes, we're seeing a tremendous rise in crude oil prices, but we're also seeing a big rise in the discounts that Russia is having to offer for its crude, so it's not getting anything like the sort of headline prices for its oil exports. And maybe this is, you know, at best a way of putting incremental pressure on Russia without perhaps being able to turn the taps off fully in a single go. But the other thing I think to bear in mind is we've had this announcement of a release of oil from strategic reserves held by member countries of the International Energy Agency. That organization or its members hold about 1.5 billion barrels of oil in strategic storage. The release that's been announced to date is for about 4% of that. So there is a lot more that can be done to release oil from strategic stockpiles. And I don't think this is going to be a sort of one and done with strategic oil releases. There are going to have to be more. And that may be a way of limiting the impact of reducing imports from Russia.
Well, Julian, I want to pick up on the South sanctioning. And if the team in the control room can bring up that quote from Shell, the statement that we had from them over the weekend. Julian, this was fascinating to see Shell essentially justifying, almost apologizing for buying Russian crude at a discount, turning around and essentially saying the money we make on it will hand over to a charity. Julian, as you point out, we are already self-sanctioning. The oil producers feel embarrassed about dealing with Russia already, and I just wonder what the broader ramifications, the consequences of that are going to be going forward, even if, as you point out, the US don't make this decision.
I think that the ramifications are going to be that there is going to be a lot less Russian oil, whether it's crude oil or refined products, that finds markets in Europe or in North America. It's quite clear that there is a strong degree of public pressure against these trades. Shell, I think, as a company, if its corporate memory is long enough, will be very well aware of the damage that public outrage can do, not just to its reputation, but to its bottom line. I mean, I can remember the days of Brent Spar when they wanted to basically sink an old production facility in the North Sea. They eventually backed down because customers stopped buying their petrol and their diesel, particularly in countries like Germany. And if we see that kind of pressure on oil companies again, then I think we are going to see a significant reduction in the volumes that Russia is able to sell.
We're introducing a reputational issue here as well. Julian Lee, thank you, sir. Abby, we've talked about this for weeks now. It's company after company stepping back from Russia.
It certainly is, John. Just an absolute exodus. Any company that you can think of really has pulled ties from Russia, really cutting their ties from Russia. That self-sanctioning that you're talking about, sanctioning on their own, whether it's VW, Shell, IKEA, and Shell, of course, that controversial buy on Friday, causing them to do that interesting apology over the weekend. Netflix, Nike, Disney, and it's really hurting the Russian economy. If we take a look at what happened in 2021, big growth for Russia. Energy at 59.3% export contribution for them. Overall, 46%. Credit cards, out 2 credit cards. Russia apparently reaching out to China, but it seems that these self-sanctions are working, cutting Russia off from the world, John.
Abby, thank you. 23 minutes in, stocks down 9/10. Your trading diary up next. Down not even 0.1% of the open, now down 0.7% on the S&P. For the crude market, a massive turnaround from where we were overnight. That's the price action. Here's your trading diary. President Biden discussing the war in Ukraine with European and UK leaders at 10:30 Eastern. European GDP coming up on Tuesday. The big one on Thursday with US CPI, plus an ECB rate decision and President Lagarde news conference. And finally, University of Michigan consumer sentiment to close out the week on Friday. From New York City, this was the Countdown to the Open.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on Monday, March 7th. Here are the top market stories we are following for you at this hour. Escalations and embargoes. War in Ukraine rages on as Putin again says it will continue until his demands are met. Germany says no to an embargo of Russian oil, while the U.S. weighs acting alone to impose one. Crude awakening. Oil prices skyrocket, then fall back to earth, while European natural gas hits a record and nickel surges past $40,000. The U.S. 10-year break-even hits the highest since 2005, and fears of stagflation rise. And China enters the chat. Beijing declares its ties with Russia are rock solid, and that security disputes over Taiwan and Ukraine are not comparable at all. We'll have more on the latest from the National People's Congress. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off. Welcome to Bloomberg Markets. Guy, it's a new week, and it doesn't really seem the market has anything or has any idea what to do differently than it did on Friday.
So you were in early, I was in early. When we both got in first thing this morning, Kaylee, what did the markets look like then? European equities smashed lower, crude prices sharply higher. Now look where we are.
Yeah, it has been such a remarkable turnaround. My question is, Guy, what changed?
I don't think anything changed. I just think, so if you think about it, the market's meant to be a weighing mechanism, but I'm not sure it's able to operate in these kinds of environments. I think it's really struggling. I think various markets are really struggling to figure out what is happening here, and as a result of which the price action is absolutely extraordinary. European equities were down 4-5%. When they opened this morning. Massive gap lower. Since then, we filled that gap. We're back in positive territory. You look at what's happening in the crude market. It is all over the place. We don't know, I think, what is going to happen next. And as a result of which, we're dealing with uncertainty, which is unquantifiable, rather than risk, which is quantifiable. I keep talking about this, but I think it's true. And as a result of which, the market is really struggling. The oil story, though, is definitely front and center. And you are clearly, as in the markets, I think getting a balancing act sort of becoming more and more real in terms of what I think Europe is wanting to do, what the US is wanting to do in terms of the energy market. Are we going to see a long-term move away from Russian crude, from Russian gas? I think that probably is becoming increasingly inevitable. Are we going to see that in the short term? I think that's a much more difficult and hard to manage scenario. That certainly is the line coming out of the Germans. But our question of the day is, does a potential oil embargo mean stagflation? Remember, we're building up to the ECB on Thursday. That's going to be fascinating. What is the central bank going to do? Joining us to discuss this, Julian Lee and Bloomberg's Mike McKee. Julian, I want to start with you. Let's kind of bring up the subject that Kaylee and I have been wrestling with all morning, and that is this market capable of accurately pricing the price of energy right now?
No, I don't think it is. I think I absolutely agree with your view that what we have at the moment is not an attempt to price risk. It's an attempt to price uncertainty. And everyone is floundering at the moment. I think everyone is trying to get a grip on what's going to happen. Is there an end to this that is some kind of a negotiated settlement that means that this is over relatively quickly? Is this going to be a long and grinding conflict, perhaps similar to what we've seen of the Russian involvement in Syria? And people are just, I think, struggling to really understand what is going to happen. I really don't think anybody has a really good idea on that at the moment.
Well, Julian, just to follow up with you quickly before we bring Mike in, what would the actual impact of an official oil embargo be when it doesn't seem that anyone is touching Russian crude in the first place at the moment?
Well, I think that's a very good question. I mean, we have got a very high degree of sort of self-sanctioning going on. We're seeing unions refusing to unload Russian cargoes from non-Russian ships. We've seen governments banning Russian ships from calling at their ports. We've seen companies shying away from buying Russian oil. But I think that's still a relatively limited number of countries where that's happening. I think if we were to get an out-and-out embargo, things would start to look very different very quickly. Clearly what we would need in that case, and what we probably need in any case, is a second and probably subsequently more releases of oil, both crude and refined products, from strategic stockpiles. The release that we've had announced so far, this coordinated release of 60 million barrels, that's only about 4% of the total that the countries who are members of the International Energy Agency hold. So there is plenty of scope for more releases over a period of time to offset some of the impact of either an embargo or this sort of self-sanctioning of Russian oil.
Mike, let's bring you into the conversation and maybe get to the heart of what we're trying to figure out here, which is at what point do we start to see demand destruction? At what point do these high energy costs actually have a meaningful impact and potentially precipitate a recession either here or in the United States? If you take a look at the curve, we have got Brent crude priced at 100 for most of this year. Is that going to be enough?
That's hard to say, Guy, and I think if it comes down to 100, because we're well over that now, it probably doesn't mean as much demand destruction. But of course, it depends on where you live, because it's not just crude oil. In Europe, it's natural gas as well, and around the world, it's going to be food prices. You go back to 2008, and at that point, oil prices were in the $130 to $140 a barrel range, but they came down relatively quickly when the great financial crisis started. If this war ends quickly, we'll have elevated gasoline prices. People will complain, but then they will come back down again. The other aspect of it is we've gotten more energy efficient, and you look at where we were, we've got the CPI coming up this week in the United States, where we were in 2008 compared to now. Oil was 9.7% of CPI then, now it's 7.35%. Gasoline 5.2%, now it's 3 3/4. And wheat futures show that food prices haven't changed, haven't gone down significantly. So I'd keep an eye on food as well. But at this point, there are some other things that are going down in price. And so if that continues, we're seeing used cars fall off in price and housing prices flatten out. It may not be as bad as it appears from the CPI statistics.
Okay, so we're talking about at what point demand destruction may kick in, Julian. At what point could we actually see more of a supply side reaction? OPEC Plus changing its calculus, shale starting to drill once more?
I think both of those are possible. I mean, I was disappointed, let's leave it at that, as the IEA were, to see not just that the OPEC Plus group didn't open the taps more quickly or agree to open the taps more quickly for April, but that they seemed more interested in how quickly they could get through the meeting than they did in actually discussing anything important. I mean, we are here in the middle of what is, a crisis in the energy system and certainly in oil, and they didn't even discuss it. The one attempt to discuss it seems to have been shut down very, very quickly. I know it's difficult that Russia is a co-chair of OPEC Plus, but the OPEC group has a long history of being able to deal with its members, even being at war with each other, and continuing to discuss the oil market and how to deal with it. So I'm very disappointed that they couldn't even bring themselves to raise the subject. Yeah. And I think that means that we may not get the sort of response that perhaps we hope for out of them anytime soon. Yeah. And that means that the additional supply has to come from elsewhere, and I think the US shale patch is the obvious earliest mover. Perhaps we'll see some planned maintenance for later in the year being pushed back, and perhaps we will start to see some new oil field developments being approved that maybe otherwise wouldn't have been.
Okay, so but the essence of what you're saying, Julian, is that the supply side response is not happening now, i.e. OPEC is not stepping up. The supply side out of the United States is still some way away. We need to deal with the idea of discipline and whether or not that can kind of go to the wayside at the moment. Mike, so we don't have a supply side response. Oil is going to remain high. I want to come back, and I hear what you're saying about the fact that other things are going down in price, but nevertheless, consumers see what is happening at the gasoline station. There is a certain amount of sticker shock that happens when you see, I don't know, what is it over there right now? $4 a gallon, north of that going higher. There is a certain amount of sticker shock, and maybe people stop buying other things. There will be an economic effect. What does history tell us about that economic effect? I understand that the demand shock will happen much later because we're much more energy efficient. But nevertheless, how much higher from here do you estimate the prices will need to go before we start to see significant demand destruction?
Well, we've not ever been able to really quantify that, Guy, except that when you look at the statistics for when consumers start to pull back a little bit, it is when we make new highs in gasoline prices. When we went over $4 the last time, then we started to see some significantly less buying in petroleum products, and probably it's a $5 level now. But of course, we have varying prices all across the United States. In California, it's been over $5 for some time. So it's probably going to be somewhere north of $5, and then people will cut back on driving and cut back on spending other things. But the money, because of the shale industry, much more of it stays in the United States. It doesn't go over to Saudi Arabia. And so then the question becomes, and Julian's going to know more than I, do the oil companies start to put that money to work in terms of E&P in the U.S.?
Well, another question, Mike, we've seen that a lot can happen in a single day. That means even more can happen in the 9 days between now and the Federal Reserve meeting. Is that baked in, or could something seriously change before the FOMC makes its decision?
Well, I wouldn't want to say nothing could change, because obviously there are some really terrible, very long tail of possibilities out there. But the Fed at this point is probably going to be pretty much on track to start raising rates. It's the how many they do. You know, we've come back from 7 now to about 5, and they may come back further if the economy starts to weaken because of this.
All right, it's going to all come down to the dot plot, I think. Bloomberg's Michael McKee and Julian Lee, thank you both so much. Now, we do want to point out that UK Prime Minister Boris Johnson is speaking. He is currently talking about oil and gas from Russia. He says that it cannot be closed down overnight, and he says it is key for allies to move in the same direction, probably a remark targeted at the U.S. that we understand is considering going it alone in this. We also got a headline out of Canada, the Prime Minister, Justin Trudeau, speaking to reporters in London, saying that they will also sanction 10 individuals from Russia. So we will continue to monitor those headlines. Now, coming up, we'll talk more about the market implications of all of this, because despite the slump, our next guest, she is not tempted to bottom fish with certain assets. Ellen Hazen, FL Putnam Investment Management Chief Market Strategist, will join us next. This is Bloomberg.
Russia invades Ukraine.
We have proven our strength.
The nature of this war changed yesterday.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
Ground troops are closing in on the Ukrainian capital.
Swiss abandon neutrality.
And analysis of what it all means to you.
Energy is on the table.
We could see oil prices moving closer to 120.
There is a lot of interest to offload Russian assets.
Look to see more companies announce their exits from Russia.
Keep it tuned to Bloomberg Television and Radio.
It's about 10:15 a.m. in New York, and the picture looks very, very different than when I came into the office about 7 hours ago. Markets absolutely roiled by each and every headline we are getting when it comes to Russia and Ukraine and a potential oil embargo that the U.S. is considering. Right now, WTI crude up about 3.5%, $1.19 a barrel. That is well off the highs we saw earlier. And of course, the moves we're seeing really across the commodities complex are fueling concerns about stagflation. So that brings us to our question of the day. Does a potential oil embargo mean stagflation? Ellen Hazen, FL Putnam Investment Management Chief Market Strategist, joins us now. They have $4.2 billion in assets under management. Ellen, before we get to the broader stagflation question, just looking at markets, which today is not an unusual event, that they've swung wildly intraday when it comes to the future session, looking very different than the cash session. How do you approach putting money to work or not putting it to work in this kind of environment?
We try to have a long-term focus where we'll take cash that we have on the sidelines and invest it opportunistically and tactically, but not to make all our bets at one time. So it's always true that on Sunday nights and Monday mornings, the market open can be fairly messy, where what we see in the futures market on Sunday night doesn't always play through into Monday. And then similarly, the European Open doesn't always play through to the US Open. So I don't think it makes sense to try to be really tactical and try to do things on a day-to-day basis, but rather have a plan for how we're going to invest money and do so when the market gives us opportunities.
Ellen, how much has that strategic plan changed since the beginning of the year? Since the beginning of the year, we have massively repriced the Fed, and we now have war in Europe. In that kind of environment, is it even possible to be strategic about these markets?
We always need to watch what the market is telling us and what the market internals are telling us. When we entered the year, we were looking for decelerating growth in the U.S. That is still going to happen. It's probably going to be decelerating potentially even faster by these higher oil prices. We were looking for inflation to remain high and maybe ease off in the second half of the year, and that's still the case, but it's exacerbated. At the same time, the U.S. economy looked like it was in pretty strong shape, with very low unemployment, strong jobs, strong corporate profit growth, and that still looks to be the same too. So as unfortunate and tragic as these events have been that have happened in Europe and are happening now, for the most part, they have exaggerated or exacerbated the trends that we already saw happening in the U.S. market.
Well, Ellen, as you say, we were already worried about inflation, but that fear seems to have more into a fear around stagflation. Do you think that's the kind of world that we're heading towards, and how do you position yourself in that environment?
I think in a higher inflation environment, you want to invest in real assets, whether it's real estate, infrastructure, commodities, and frankly, equities. In terms of stagflation, though, we're not seeing a wage price spiral. That was one of the big takeaways from last week's job number, is that wages were flat on a month-over-month basis. So that's one of the things we'll continue to be watching really closely in terms of inflation getting out of control.
But in this kind of environment, one thing that we may see crack is profitability. Are we going to continue to see the earnings numbers that we've been seeing produced by U.S. companies as a result of this changing environment? There's certain elements within the data, Ellen, that I'm starting to see, maybe suggesting that that profitability is beginning to crack.
Absolutely. There's no question, if you listen to the Q4 earnings calls and the off-quarter earnings calls that have happened since then, and what companies are saying at conferences and other appearances, that costs are taking a bite out of their profit structure, and I expect earnings estimates to continue to come down throughout the rest of this year. But they're not going to go negative. They will be lower than they were going to be 2 months ago.
Where do you find the best pricing power, Ellen?
We're looking in areas of healthcare. In the U.S., healthcare has a fair amount of pricing power. Some areas of technology still have pricing power. And where we're not seeing it so much is in areas that have some of these highest labor costs. And so it's going to be a little bit more of a challenge for them, but some commodities areas have a tougher time with pricing power. The other place we're really not seeing it is in consumer staples. They are good at taking small price increases, but large price increases cause a lot of demand destruction. And so we're staying away from consumer staples.
And you talk about pricing. Let me drag it back to the markets and talk about market pricing. You talked earlier about the fact that we may be you may see some opportunities as a result of what is happening here. This is a very macro market right now. We've got huge blocks of the market moving together. Within those blocks, there are going to be mispriced assets. At this stage, is it possible to detect those mispriced assets? Are you starting to think about ways of playing that as an opportunity?
We're certainly looking at individual companies all the time. And with the increased volatility that we've seen in the stock market this year, it does provide more opportunities. Some of the correlations, although they have increased, break down from day to day, and then we can find interesting opportunities within some individual stocks.
How much dry powder do you want to have at the ready for when those opportunities arise? How much cash do you want to have, Ellen?
We think it makes sense to have a modest amount of cash, so maybe 2.5% to 5% of a portfolio that's balanced between equities and fixed income, because it's really difficult to time the market. And of course, it is always the case that whenever the market takes an enormous nosedive is the time that it is most difficult to actually put that money to work from a human behavioral standpoint. And so we want to be measured and disciplined and be largely invested, but keeping some dry powder in cash. Having said that, fixed income also serves as a source of dry powder, and that's a much larger allocation.
In terms of how those allocations have changed, are you rethinking what is happening? And just to come back to the stagflation question, as you say, in theory, fixed income should provide a ballast. Does that apply if we end up in a more stagflationary environment? I'm not talking about a fully stagflationary environment, but if we're edging in that direction, does that 60-40 structure, let's say, still work?
Yes, it does. I think that fixed income returns are going to be lower in the future than they have been in recent years. We're exiting, as it appears, a 30-year bull market in bonds with declining interest rates, as we all know. So we can't expect the same type of bond returns that we had historically. So bond returns are likely to be low to mid-single digits at best, and some years negative, as many parts of the bond market were last year. But that's still dry powder. Even if returns are very, very modest, that's still much better than the volatility you're going to see in the equity market, and so therefore it provides the opportunity.
Really useful update, Ellen. Thanks for spending some time with us today. Really appreciate it. Ellen Hazen, FL Putnam Investment Management Chief Market Strategist. Thank you very much indeed. This is Bloomberg.
This is Bloomberg.
Justin Trudeau, Mark Rutte in London, a press conference taking place right now with the British Prime Minister Boris Johnson. Boris Johnson answering questions, laying out what he sees happening in terms of UK energy policy. Clearly there is a debate taking place at the upper echelons of global government about whether or not we should see an energy embargo against Russia. Boris Johnson talking about this, talking about the fact that it is key that all allies are basically moving in the same direction on this. Doesn't talk about pace there. Talking about the fact, though, that you can't close down oil and gas overnight from Russia. Clearly, the market is making a fairly decent stab at that, though. He's talking as well about the economic crime bill, which is being altered to make it more difficult for oligarchs and billionaires to hide their assets, and talking about the fact that the UK will be laying out its energy supply strategy over the next few days. We'll continue to monitor what is happening here. Clearly, a debate, as I say, taking place between the United States and its allies. We saw Antony Blinken over the weekend talking about that oil embargo. Everybody's now making their voices heard on this one, including the Germans, who are being very cautious on this, understandably. Okay, coming up, Jane Vineman, Temple University Political Science Assistant Professor. That conversation next. This is Bloomberg.
We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, it's been another one of those days, sharply down, back up, and now we're down again.
A real roller coaster ride here. Here are the NASDAQ 100 futures really talking about those crazy, wild moves that we're really getting used to this year. At session lows overnight, the NASDAQ 100 futures down about 2%. And then right around the time of the open, going ever so slightly higher. This, of course, as crude oil went from being up 13% WTI crude, Brent crude up 18% to almost down. But now you can see crude oil is going higher as the NASDAQ 100 futures are going lower, or perhaps I should say NASDAQ 100 futures are going lower as crude oil is going higher, which we'll be taking a look at in one moment. But when we take a look at some of the other indexes, we're going to see that the weakness really extends. Now, the S&P 500 E-mini futures at session lows, similar to the NASDAQ 100 futures, down 2%. On the open, though, down just fractionally, now down 1.4%. You can see that the KBW Bank Index down 2.2%. This despite the fact that yields are higher as bonds are selling off a little bit. Even with all this volatility, the Russell 2000 on the open had been higher, now down about 0.6%. The big mover there, a standout mover, Bed Bath & Beyond, up 60% at the highs, up closer to 80%, the best day ever. This, of course, as Chewy founder has taken a 10% stake and is recommending a sale. As for the driver for the markets, because we go through these time periods where it could be the dollar, it could be yields, it could be oil. Well, right now it's oil. Brent crude now up 4%. So as oil has ticked back higher, that is pressing on stocks. We can see futures for wheat also higher at this point. On the other hand, though, you have metals within the commodity complex trading lower. The big question is, what is next overall? Of course, nobody has a crystal ball. If we take a look at a chart of the Bloomberg Commodity Index, though, we are going to see something that does have a tradable, predictable trend, and that is a parabolic uptrend. This is a 5-year chart of the Bloomberg Commodity Index relative to its 200-day moving average. You can see for a few years there, really with trend on the COVID crash, well below, then recovering, all of that around oil. Right now, an absolute parabolic uptrend, a 90-degree angle. Physics, it cannot hold. At some point, it will probably reverse. Even I could say it will reverse up 33% on the year, the highest level since 2014. You could see all of that reverse and then some, Guy. The volatility is very likely to continue. It wouldn't be surprising to see this reverse relatively soon, Guy.
It's really hard to get a grip on these markets. Even the volatility market, I think, struggling to get a grip on what is happening here with the volatility. Abigail, thank you very much indeed. Abigail Doolittle on what's happening in the markets. A few headlines I need to update you on. The first one is it looks like the latest round of talks between the Ukrainian officials and the Russian officials, those talks are now starting. We're also getting some commentary coming through from EU officials. I assume this is EU officials. Details matter here. Poland and other EU states pushing for a Russian energy ban. Germany facing growing pressure to accept such a ban. We heard from both the German finance minister and the chancellor a little bit earlier on pushing back on this. More tepid pushback, but still some pushback from Boris Johnson over the last few minutes within the UK, saying basically you can't switch these things on a dime. The US, obviously front and center in all of this. We heard from Blinken over the weekend. Congress is now exploring a bill that would effectively ban the import of Russian oil. Bloomberg's Washington correspondent Amory Hordern at the White House joining us now. Amory, it was made clear over the weekend that the US potentially was prepared to go it alone. Is the expectation, though, in Washington that that will actually happen? Or is there an expectation that ultimately the Europeans will side with the US and pursue this ban on Russian energy?
Well, Secretary of State Antony Blinken has said that they're in discussions with leaders of the European Union to do this multilaterally, as a multilateral approach. The way they've done a number of these sanctions, very much so in lockstep. The issue, Guy, which you just really outlined, is that these European economies are not prepared for it. Olaf Scholz throwing a ton of cold water on this idea, saying that, yes, they are urgently looking for other supplies, but this is not something that can be done overnight. And Russia energy sources are incremental to their own economies. So it does look like the United States would have no choice but to go it alone. And this White House is under an immense amount of political pressure from Capitol Hill to do just that. But we should note that this would just be putting a name on already what is happening in the physical market. This has been a story for days. Refiners have been shutting these assets anyway. There's been an embargo already, just not in name. But this is just the White House that would probably just make that a little bit more clear.
A lot of self-sanctioning already taking place. Thank you so much to Bloomberg's Anne-Marie Horton at the White House for us. Now for more, let's bring in Jane Vainman, Temple University Assistant Professor of Political Science. Jane, let's talk about the political repercussions of a move like this. If the U.S. moves without its allies, what would the repercussions be internationally? And then domestically, is the U.S. population in support of such a move?
I don't know if I would expect the U.S. to move without its allies at this point. The administration's coordination with allies has been very close up through now, so I would expect to see that continue. If there's going to be public support for it, or if the U.S. goes alone or together, it's hard to tell.
Let's talk about how Russia might respond. Von Clausewitz talks about war and business basically being the same thing in so many respects. At the moment, we have Russia waging war. We have the West, Europe and the United States waging economic war. In terms of escalation, how do the two fit together? How should we think about those two things fitting together? Is this an equivalent military response that we should think about when we think about maybe such an embargo being put in place?
This is a very good question because this is a situation where one side is primarily using economic levers and the other side is clearly using classic military ones. So to what extent does Russia perceive the very severe economic moves that the other states are making as a direct threat? And Putin has stated already that he finds this very threatening. He keeps referring to threatening statements by the other side. But in terms of escalation, it's hard to know how he will perceive this. And I think that uncertainty about how Russia will perceive the next step of economic moves by the West is a reason to evaluate this very closely. Traditionally, I would say that economic moves, I would not necessarily anticipate a direct military escalation in response to those because, as you said, they're sort of not very well matched. But this crisis has raised a lot of uncertainty about what Putin intends to do and is capable of doing.
So economic moves may not lead to an escalation. Is it possible, Jane, that they lead to a de-escalation? I mean, will this change anything about Putin's current behavior?
This is something that I've been thinking a lot about because the traditional kind of way we would think about compelling an adversary would be to say, okay, we're going to apply this set of punishments until you change what you are doing. But in this case, what we're not seeing is any clear demands or statements like, okay, these punishments will continue and Russia should do X and Y. Russia doesn't really sort of have a list of what it should do. So without these kind of off-ramps, Putin might as well see that these things will continue regardless of what he does in Ukraine. So on one hand, that seems... Oh, sorry, go ahead.
Sorry, okay, just picking up on that point. In terms of the duration of the sanctions, therefore, how important is the time that they last? Because the West is now talking about, Europe in particular is now talking about weaning itself off Russian energy. And if that is going to be a long-term story, then that changes the calculation in Moscow. If the West says, you know what, if you do X, we will do Y, and that will happen relatively quickly, then you can see a kind of causality in this whole process. But if there is now a long-term sort of move away from Russian energy, economic pain is going to persist in the long term. How does that change the calculus?
Yeah, so I think there's a lot of potential benefits to waiting to make any kind of demand for what Russia could do. The exact size and magnitude of the pain imposed by these sanctions is revealed over time. And it seems that the Russian government has perhaps underestimated how intense this is going to have, of an effect this is going to have. So we need that time and potentially quite a long time in order to for them to even fully understand what the cost is going to be. Also, the situation on the ground in Ukraine is changing. So there's not necessarily a logic for right now asking for Russia to do something when we don't really know what they should do and how the situation will develop. Yeah. But as it gets further and further and these economic moves become more and more difficult to turn off or remove in some way, it becomes more difficult to convince Putin that any of this will go away if he changes his behavior. In some cases, turning those off, the governments are not even capable of turning those off. As private companies make choices about whether or not they're in the Russian market. You just brought up, I believe in your discussion, self-sanctioning.
Yeah.
A government can't promise to make that all go away if Russia just turns around and leaves Ukraine.
Okay, so Jane, obviously we've been talking a lot about the response we've seen from the U.S., from Europe, from the West, if we call it that. What about the response we haven't seen from places like China? Is that ultimately going to be the linchpin in all of this? Is China's perceived, at least if not outright allyship, backstop for Russia?
I'm not sure to the extent to which it's a backstop. I think China's position definitely matters here. I've been paying close attention to what China has been saying and not saying. I know others are as well. They've been very hesitant so far to say much of anything, but they seem to have some support for what Russia is doing, even though it's limited, and they've cautioned that they want to see a resolution to this conflict as soon as possible. However, are they the ultimate linchpin that is somehow going to turn this around where Russia suddenly feels too much pain? I don't know, because there's quite a bit of punishment being placed on Russia and pressure being placed on Russia already. Yeah. So I don't think we necessarily essentially need China to play a critical role here.
Jane, is deterrence theory, is mutually assured destruction still operating?
I think so. I think when we're talking about the relationship between Russia and NATO, yes, the basic concepts of mutually assured destruction, mutual nuclear annihilation are still there. I'm not particularly worried about Putin attacking, using nuclear weapons against a NATO country. NATO is a nuclear alliance, and I think he is deterred by nuclear retaliation by NATO.
Jane, we'll leave it there. Really appreciate your time today and your analysis. Thank you very much. Jane Vaiman of Temple University. Thank you. What we got coming up for you? China's foreign minister is warning, we've just been discussing this, the United States against trying to build a Pacific version of NATO, and says the issues over Taiwan and Ukraine are, quote, not comparable at all. We're going to discuss all of this with Anna Ashton, Society Policy Institute Senior Fellow. Joining us next, this is Bloomberg.
This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. The European Union is calling for fast action to ensure the safety of Ukraine's nuclear power plants, two of which have been seized by invading Russian forces. In a letter to the International Atomic Energy Agency, the EU Energy Commission urged Moscow to return control to Ukraine. It said missile strikes at Europe's largest plant and its recent takeover are unacceptable. More than 5,000 people left Hong Kong Sunday. That's the most since the city was hit with its most severe and far-reaching COVID wave. That brought last week's departures to nearly 23,000. That's up more than 4% from the week before. Those considering coming back face long spells in quarantine. Hong Kong now has the highest COVID-19 death rate in the world. And China has announced a GDP goal of about 5.5% for this year. That's at the higher end of many economists' forecasts and quicker than the 4.8% expansion forecast by the IMF. Beijing is expected to stimulate the economy, loosening controls on the housing market and increasing infrastructure investment. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Guy.
Ritika, thank you very much indeed. Let's pick up on that subject. China's Foreign Minister Wang Yi echoing President Putin's complaints about the US alliance. In his annual news briefing, he warned the US against forming a Pacific version of NATO. For more now, we're joined by Anna Ashton, Society Policy Institute Senior Fellow for Trade, Investment and Innovation in the Asia region. Anna, thank you very much indeed for spending some time with us today. I want to talk about this sort of big picture, first of all. The Chinese targets, the Chinese objectives that have been laid out this weekend, to what extent are they premised on old assumptions? Old assumptions for the price of crude, old assumptions for the price of nickel, old assumptions for the price of pretty much anything. The world has changed over the last few days as a result of the Ukrainian invasion, and I'm wondering whether China is going to be able to deliver what it expected as a result of that.
You know, I think that we have to assume that to a large extent, these are premised on old assumptions, these numbers, because there just hasn't been time for the Chinese bureaucracy to adjust its calculations. And the truth of the matter is that 5.5%, while it is fast for pretty much any other country, is pretty slow for China. So I can't imagine them wanting to go slower than that in their goal. But reaching that goal was always going to be ambitious and is going to be more ambitious still given the situation with Ukraine.
Well, let's talk more about the situation in Ukraine and how that ties into China's economy. Does China need Russia as much as Russia needs China right now?
I mean, I think this depends on how firmly China ends up in Russia's corner and what that ends up meaning for China in terms of sanctions, secondary sanctions, being sort of tied to Russia in the punitive measures that other countries are putting in place. In terms of fundamentals, no, I don't think that China needs Russia as much as Russia needs China right now. But China certainly needs sources of energy, especially oil and natural gas. And Russia is a border country with a significant amount of that. So, and it'll probably be cheaper right now. So I think they've got some tough calculating and balancing to do to try to figure out exactly how they want to move forward and what their stand is going to be as this evolves.
The lesson learned to many is that the US holds considerable financial clout still, and the assets that you hold abroad are not necessarily yours in times of conflict, Anna. How will the Chinese be thinking over the next few years, be thinking about economic plans, and how will they be changing those plans as a result of what is happening to Russia right now?
Well, you know, it's interesting. I was listening to a conversation about this morning, and I think somebody pointed out that SWIFT has the ability to tie up and complicate all sorts of transactions for any country in the world, pretty much. And China doesn't have a system that is equivalently, I guess, large, and it doesn't have the ability to sort of separate from SWIFT and not take a pretty big hit. Furthermore, I think, you know, we have to consider the fact that China's economy is not like Russia's economy. Russia's economy is primarily an oil and gas economy, China's economy relies on trade in a much more, I think, all-pervasive way. And so I can't really imagine a scenario where China can truly decouple itself from the rest of the world and end up succeeding in growing its economy, especially when we're looking at consumer demand being down right now.
Okay, Anna, so when looking at the situation we have seen playing out with Western sanctions on Russia after the invasion of Ukraine, how do you think that has changed China's view of the leeway it does or does not have when it comes to any potential action on Taiwan?
Well, I think China doesn't want to see a comparison drawn there, and there are major differences, but certainly a comparison can be drawn, at least to some extent. And I think fundamentally, one of the things that must be standing out to China is that they would never want a situation where they're trying to take Taiwan and take control of Taiwan to end up being violent the way that this situation has. So perhaps that gives them pause about how they imagine a scenario like this going.
Anna, just one final quick question from me. We were just hearing from Ritika about the situation in Hong Kong and the departures we're seeing there. There were hints within the speeches over the weekend that zero COVID policy is going to be dialed back. My question is, what kind of sense do we have in terms of the timing of that? How quickly is that going to happen? Because again, this comes back to the issue of global supply chains. Global supply chains remain remain sort of blocked at the moment as a result of zero COVID in China. How quickly do we think that's going to unwind?
Yeah, I mean, I think that there is growing pressure for there to be some sort of loosening of the zero COVID response. But I don't think that we're going to see just ripping the Band-Aid off and everything going back to normal, because we do have this outbreak in Hong Kong. We do still have like a significant percentage of the elderly population, not just in Hong Kong, but as I understand it, in mainland China too, that is somewhat averse to the vaccines. So sort of the opposite of the situation that we have in the United States. And that makes the society pretty vulnerable when there is an outbreak that starts to pick up steam. I do think that they recognize, though, that zero COVID is not helping boost consumer demand, and it is complicating the supply chains, yes.
Yeah, and of course that has ripple effects all across the globe. It is not just a China issue. Thank you so much to Anna Ashton, Asia Society Policy Institute Senior Fellow. This is Bloomberg.
It's been quite the session this Monday. When I got in this morning, when Kayleigh got in this morning, European equities were massively on offer. We were down 3, 4, 5%. Pick your index. We've come back significantly since then. As we head towards the close in around 30 minutes time, the Stock 600 is trading 417. We're down by just 0.9%. One of the reasons behind that is that we've seen a significant move in the price of crude, which has come back down again. Nevertheless, if you take a look at what is happening with Nat Gas, which was up by 40% sort of earlier, we've come down again quite significantly. That's the Dutch contract. We're up by 19% still. So gas prices moving ever higher and higher and higher. Euro Swissy moving through parity. We've got a big week coming up, haven't we? The ECB on Thursday. That's certainly something that is going to be a great focus on the same day as we come through with US inflation data. We'll talk all about that next. Mark Dowding, BlueBay's Chief Investment Officer, is going to be joining us. We'll work our way through what has been, as I say, an incredible session. The close is next. This is Bloomberg. Monday, March the 7th, European stocks are down, but the bounce off the lows has been huge. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Markets are meant to be a weighing mechanism for risk. I think they're really struggling with that right now. The volatility that we're getting, the price swings, enormous. We've certainly seen that coming in to today. First thing this morning, European stocks down 3, 4, in some cases 5%. I'm talking about the indexes here. We have rallied hugely since then. Yes, we're still down, but look at that. The Stoxx 600 only down by 1%. That feels like a relatively normal session. There was nothing normal about the price picture first thing this morning. Similar story for European gas as well. Huge spike this morning and then a fade off that move. But again, still, we're up by 18, nearly 19% right now. The foreign exchange market's not immune from this volatility. We're seeing Euro Swissy through parity. The euro certainly has had a real struggle. What are we going to get from Christine Lagarde, the ECB president, this Thursday? Kaylee.
Well, Guy, if only that was the only event we're going to have to watch on Thursday. But we also get U.S. CPI inflation data going to be absolutely crucial, as this looks like a market increasingly worried about stagflation, just not quite sure how it's supposed to price that. As we've seen those massive swings in the European session, we saw them too in the future session here in the U.S. When I came into the office at dark 30 this morning, futures were down hard. Then we saw NASDAQ 100 futures actually going into positive territory. Now the index is back down about 2 full percentage points, right around session low. So it is a down day for U.S. equities at the moment. When it comes to the action in the bond market, nominal yields aren't really the story. It is break-evens. The 10-year break-even yield right now only up about 3 basis points to just shy of 273. Earlier, though, it was at an all-time high when it comes to inflation expectations over the last decade. You also have the dollar getting a haven bid. The Bloomberg U.S. dollar index trading around 1,200 at its highest going back to July of 2020. And then, of course, it has been a wild session for oil. At one point, WTI was north of 130. Right now, it is just at 119, up still 3 full percentage points. But again, far off of session highs. What a wild ride, Guy, and it's only 11 a.m. Eastern time.
Yeah, still a long way to go for you guys. Mark Dowding, Blue Bay Asset Management CIO, joining us to kick this around. Mark, great to see you. We have an incredibly whippy session behind us here in Europe. The market's really struggling to price the uncertainty right now. Just in terms of the price action that you see in front of you, how useful is it to gauge what is really happening out there?
Well, I think that you're dealing, as you mentioned, with a lot of short-term uncertainty. We're dealing with scenarios as investors, and you're pricing lots of different scenarios. So this sort of short-term uncertainty, I think, is very, very understandable. I guess you try and take a longer-term view and look through some of this, however. And I would suggest, on the one hand, you're trying to price recession risk. On the other hand, you're trying to price inflation risk. But the other thing that shouldn't be forgotten is I also think there'll be a big fiscal policy response that's coming out of Europe sometime soon.
What about the monetary response coming out of Europe, Mark? I mean, how has this changed the equation for the ECB when you have real growth concern on one hand, but what could be even more exacerbated inflation on the other?
Yeah, well, it's a great point. Obviously, we get the ECB on Thursday. We'll be hanging on Lagarde's every word. Obviously, the thing that we do know is Europe is much more impacted here than the US economy is. But in terms of our own modelling, we think that with oil around about $120, you're probably taking about 1.5 percentage points off of economic growth. You're probably putting the same amount onto inflation. And in that context, we think that ultimately we're going to see central banks go down a path where they continue to need to normalise monetary policy during the course of 2022. At this Thursday's meeting, though, I think that Lagarde probably should take the opportunity to kick the can down the road and just wait for a few weeks, given the uncertainty that we're currently facing. But ultimately, we do think that asset purchases will draw to an end at the end of this year. Interest rates up in Q1 in 2023. You probably get rates back to zero by the end of next March next year.
Is Europe in that scenario heading for a recession? How does that recession impact different parts of Europe? Or are we talking about, well, maybe you hinted about this, stagflation?
Yeah, so it's interesting that people were talking about recession in Europe. But I think the thing that you have to remember is we've been looking at this year to begin with. I know that with COVID and now Russia, we're out the frying pan into the fire. metaphorically speaking, but we were looking at this being a really quite strong growth year for Europe. We thought that growth could hit 4% this year in Europe. So even if you're taking off 1.5%, a couple of percent off European growth, you're still looking at a 2% year. I don't think it's going to be recession. If we'd have been starting with a growth forecast of 2, then yes, you would be flirting with recession. But I think recession's unlikely, also because of fiscal policy. You are definitely going to see a load of spending on military, on energy infrastructure, and also on the refugee crisis. And that's why wartime economies don't tend to experience recession, but you have got the inflation risk.
Okay, so what does that mean for European equities relative to other regions of the world, Mark?
So as an equity investor, it's obviously a very uncertain time, right? And there's going to be big winners, big losers as we go through some of this. And these are the themes that the investors are going to have to weigh up. I would say that you're going to come through this where risk premium is going to stay elevated. We think you're going to end up with some sort of stalemate, which puts us into a new Cold War sort of setting that could last for a long, long time. Against that sort of backdrop, risk premium aren't really going to go away. So it's not going to be a great year for investors, we think, either in fixed income or in equities this year. The money to be made is more in picking moments in distressed assets. The money to be made is more in relative value opportunities between one name against another or one market against the other, or even in currencies.
When does that environment start to emerge? Because at the moment this feels like a really top-down macro environment. The baby and the bathwater are being thrown out at the same time. When do you think those price distortions, the inexact pricing is going to become clearer, Mark?
So I think in a situation like this, it normally takes a couple of weeks for people to be able to sit down and reassess their portfolios. There's no doubt that people have come into this set up incredibly badly for it. A lot of fund managers who may have Russian risk in their portfolio, their main thought at the moment is how to get that Russian risk out of their portfolio. There are other things that investors are having to worry about, but you will see, I think, at some point a situation begin to settle, and you will see people start to look more medium term about what the implications are going to be. I think, though, we may well be another couple of weeks before we reach that particular point.
Does that imply, Mark, that you have Russia risk in your portfolios? And if so, what do you think that Russia risk is worth, and how are you handling it?
Well, I'm happy to say, thankfully not. At BlueBay, we had a very negative call on Russia. We'd actually, we can put our hand up and say we did our ESG homework, and we had deemed Russia as a pretty toxic place that we didn't want to be investing in. So with the exception of very small positions in a couple of emerging market portfolios that we've been running, we haven't had Russian risk. But obviously, that many others have, and they've been struggling. Here, I think you need to run with the prices that come from index providers, but some fund managers are running into real issues in terms of how to price assets which then get ejected from the indices, and how to deal with investor redemptions. There are some pretty important questions being asked at the moment, and I would say that in terms of our framework, the adoption of things like swing pricing in recent years has actually been, I think, a benefit in situations like this. But clearly, in the case of some other managers, you're going to see funds needing to close or gate or issue side pockets in order to return money to investors.
So, Mark, is that the kind of environment where you still want to find a way to stay invested, or is it time to shift more to cash, wait on the sidelines until you start to see some of those opportunities, those, individual mispricings that potentially present an entry point?
Yeah, so I think a lot of this depends on your investment time horizon. I would say that if you are looking at a portfolio that didn't have too much risk to begin with, you're now looking at the investment landscape and you're saying, what is dislocating, what is stressed, what can I buy, what can I own? Because there are things that you can pick up at this point in time which look very much mispriced. However, if you're coming into this staring heavy losses in your face, then it's more understandable that actually it's difficult to take the longer term view, and you're probably more in risk reduction mode. But But I guess to the audience, I guess my message would be, look, go with the fundamentals. And fundamentally speaking, I think that economies are going to come through this okay in the context of growth. And therefore, you should be looking at the dislocation in markets as an opportunity to buy some assets which are quite cheap. For example, European bank stocks today, this morning, I thought look very cheap when you're looking at assets which are trading at 6 times earnings.
Are you buying there then, Mark?
So as BlueBay, we're fixed income investors, but I can put my hand up and say that in my personal portfolio, yes, I was buying an index of bank stocks this morning in my pension because I had actually been in cash and I thought that now might be a decent time to buy.
What else would be on your shopping list, Mark? You mentioned that there are some dislocations now that might present opportunities. Where exactly are they?
Yeah, so as a fixed income investor, there are things that I do think are really dislocated, and some of these, forgive me if they're more idiosyncratic for some of your viewers, but things like European swap spreads, they look really wrongly priced in my mind. There's the 10-year German Bund asset swap spread has reached a level which is way beyond where it traded in 2008. And for that matter, in the sovereign crisis of 2012. So European swap spreads look very badly dislocated. That's really cheap. Other assets that we've been looking at, for example, have been some of the assets in Central Eastern Europe, which are performing just fine, economic and fundamentally speaking. They just happen to be in the wrong postcode. And in some cases, if you've got an asset in Romania, and the trader for that asset in a bank also happens to be the Russian trader, of course is marking all the prices down indiscriminately. But here we can look at things and say there's fundamentally value to be had.
There are bits of Europe that are going into this with a very high level of debt. And I hear what you're saying about the fiscal story, which you started off talking about at the beginning of our conversation, Mark. Do you worry that, and it kind of relates to the bank story as well, that as we see debt levels climbing ever higher, that particularly peripheral banks will end up in a situation similar to the one we ended up with in 2012?
So I think that will be a concern for some investors, but I think we have seen, and something that I've been quite surprised by, quite delighted by, is actually the solidarity that we've seen across the EU over the course of the past week in terms of the imposition of sanctions. There's been a real come-together moment. You could say in some sort of ironic, twisted way, Vladimir Putin has done more for European solidarity than many have come before him, right? So, and it's... The truth of the matter here is that, yes, you do need fiscal spending. And look, there is absolutely tragic and upsetting seeing the human suffering and the wave of refugees. But, for example, here where spending does need to take place, we would expect that to fall under a common budget, something similar to the Next Generation EU funding. So when it comes to Germany needing to increase its military spending, that will be on its own dime. But some of these other measures, I think, will be more Euro-driven initiatives. So in that context, it doesn't necessarily hit the periphery per se.
All right, European solidarity, NATO solidarity, probably not exactly running with what Putin originally wanted when he started this whole endeavor. Thank you so much to Mark Dowding, CIO of BlueBay Asset Management, for joining us. Now, coming up, it has been a wild session for oil. That may be the understatement of the day. Crude seeing its biggest daily swing ever after the Biden administration said it's weighing a ban on Russian imports. The question is, will the allies agree with that? We'll speak with Amrita Sen, Energy Aspects Director of Research, next. This is Bloomberg.
Big things are happening on Bloomberg in March. First, Bloomberg Triple Take, breaking down the day's biggest stories.
Today's Triple Take focused on the energy transition.
Then, the return of Bloomberg ETF IQ.
The last major holdouts of the ETF revolution.
And the debut of Bloomberg Crypto.
The CEO of Binance weighed in.
Finally, David Rubenstein brings you insights and advice from the world's greatest investors on a new season of Bloomberg Wealth. All this March, right here on Bloomberg.
Let's talk about oil because it hit $139 a barrel, the highest level in almost 14 years earlier today, while wholesale gas prices for next day delivery more than doubled. And then we've given a lot of that back. This, of course, is as the U.S. hints at a ban on buying Russian energy. Germany, though, not yet on board. The question is, will it get there? Here to break it all down is Amrita Sen, Energy Aspects Director of Research. Amrita, we just had a headline crossing from Darren Woods, the CEO of Exxon, saying we're going to see a tough time in energy markets, which I think is probably a bit of an understatement, and also having a tough time energy traders. What do you make of the price action we are seeing?
I don't think we've seen this level of volatility, and not just, the price of oil, but if you look at spreads, the level of backwardation, just what does a $5 backwardation even mean? And I think the market's really struggling to price in the scale of what we are looking at, the potential loss of what? Right now, we still have about 65 to 70% of Russian oil not moving, but potentially the scale of if there were to be an oil ban on Russian oil as well. It's just unprecedented in every single sense of that word.
Amrita, if I take a look at the curve, it prices $100 a barrel, north of $100 a barrel for really quite a long time now. Is that are we signaling that there is going to be an outage of Russian crude on the market for really quite a long time? If we're north of $100 a barrel, is that commensurate with the reality of no Russian crude being on the market for the rest of this year and some of next?
I would argue that if there's going to be no Russian crude, that curve should be even higher, significantly higher. Look, we've had $100 price forecast for 23 to 26 well before all of this, since 3 years ago. Because there's been no investment coming in, spare capacity is limited, and of course after COVID we are seeing this big demand surge. So on top of that, if we are to lose a substantial chunk of Russian crude, let's not even talk about all of